Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So stocks continue to consolidate below massive resistance. Some say this is just part of the staircase step higher that you see in a bull market. The SP500 healthily consolidating below a big resistance level, taking a breather before resuming its bull run. In fact, we do see with this recent Bank of America survey that most investors actually expect a soft landing. A soft landing meaning no recession or no significant rise in the unemployment rate, just some weaker growth like we've had in 2022. The percentage of people actually expecting a hard landing, a real recession with rising unemployment, is less than a half. So investors right now are currently pricing in the best case scenario. Now that could very well play out and we see a massive breakout. We're going to talk about that scenario in just a second. This looks much more like a big topping pattern rather than a healthy consolidation. Every single day we are getting signals underneath the surface that suggest stocks likely do have more downside risk than any upside potential. That's what I'm going to show you in this video. Don't forget to smash the like button if you enjoyed this video. And of course, subscribe to the channel if you haven't already. If you're new here, we make these videos multiple times a week looking at the markets and the economy. Now, without further ado, let's get right into it. As a quick reminder, we are doing a limited offer on our service at gameoftrades.net. We're giving out 1 month completely for free on all the features of our service so that you can test it out. We actively update and follow up on all our macro trades. The last time we did this offer, there was a huge number of you that tested out the service through that deal. So we want to make sure we're giving that chance to as many people as possible. So it won't last very long. Make sure to take advantage of it by clicking the link down below to get access to that deal. Now, before we look at the signs of deterioration we're getting in the market right now, what does a soft landing look like? What is probably the best case scenario for stocks right now? Well, you look at data since 1955 here of the federal funds rate, and we can identify 3 moments in history where we've actually seen a soft landing happen. And that is 1995 here, 1984, and 1967. You can see those were moments where the Federal Reserve was hiking interest rates quite aggressively, and it did not play out for a recession. You can see the gray bars here are US recessions. In 1967, you did not have one. 1984 and 1995, you did not have one. In every other hiking cycle, you had a recession that followed in the 1 or 2 years following the end of the hiking cycle. Now you look at what stocks did in those instances. Stocks went up very aggressively in 1996. As soon as the Federal Reserve pivoted on monetary policy, you had a massive melt-up type of move that led to the tech bubble in the late 90s. 1984, similar scenario, Fed pivots and stocks bottom, and you have a massive melt up in the market. Stocks went up so aggressively it actually led to the 1987 crash after really a melt up type of move again. And same thing in 1966 here. The Fed pivots, you see stocks bottom and rally straight away. Now you can see what's interesting about today's episode is actually we've seen stocks bottom here in October of 2022, much before the Federal Reserve actually stopped its hiking cycle. Now the Fed is likely to pause monetary policy here, but stocks already front ran quite a bit of that. But if investors are right about a soft landing scenario, you can expect the stock market to break out here. That will happen. If we don't enter a recession in the next 12 months and you see the Federal Reserve begin to pause monetary policy, you see S&P 500 earnings begin to turn back up again, that is going to lead to a breakout in the market. And clearly from this survey, it seems most investors, at least the ones that Bank of America surveyed, do expect that scenario. But if you're actually an objective investor, you'll know that this is a very unlikely scenario. If you look at data from a quantitative, unbiased standpoint, this scenario occurred 3 times in history. 3 times where you had a soft landing or no landing type of scenario out of in total 13 tightening cycles. That's a 3 in 13 chance of being right. And keep in mind, that's already priced into the market. If we see the hard landing scenario, then this is the type of price action that you can expect during a recessionary period following a tightening cycle. 1974, 1982, 2000, 2008. All of these are hard landings. There's clearly more examples of those than soft landings. If this is a hard landing, if we are heading towards a recession, the market rally will not last long. And I think it probably will fail at this level of resistance. Since the 31st of March, we've been trading perfectly sideways here on the S&P 500, but underneath the surface, it's a completely different story. If we take a look at junk bonds, a high yield bond ETF, we look at what it's been doing since the 31st of March. It's been moving down. And in fact, more recently, that's been accelerating to the downside. This is a market that is more sensitive to risk than the S&P 500. So when you see a signal of deterioration in these high yield bonds, it's a warning signal for the S&P 500. And we want to stay objective on these types of things. When you have a very strong recovery in high yield bonds, that's great news for the market. It means investors, financial markets in general, are ready to take on a lot more risk. This is not a risk on type of look that we're seeing on high yield bonds. This is a clear deterioration in the market's perception of risk. You can look at the S&P 500 on top and we have a clear divergence. The S&P 500 making an equal high here, while J&K junk bonds are moving down more and more aggressively. In fact, you can argue we have some type of a head and shoulder pattern here. Of course, this is an unconfirmed pattern, but if we begin to break down here in the next couple of days, that would be a very significant message that we're getting from credit markets regarding the overall risk that we're seeing in the economy right now. We're seeing similar type of behavior on IYT, the transportation ETF. Now, this is an ETF that's very sensitive to the economic cycle, to the business cycle. If you're in an economic boom, transportation stock go through the roof as you have a lot of demand for goods that need to be transported all around the world. And so you see these stocks outperform like we did here following the big stimulus that we had in 2020. Transportation stocks were among the leaders in that recovery. And you can see if we add the S&P 500 on top of this chart, they were already beginning to sniff out a little bit of weakness in the economy here in late 2021. As you saw this ETF, IYT, make lower highs here leading up to the end of 2021, while the market, the S&P 500, was completely disregarding any risk and just continuing to move higher. You can see here, again, a very similar divergence that we have between the S&P 500 that's disregarding economic risk, but transportation stocks that are being very sensitive here to underlying economic weakness that is starting to appear here. And you can see very similar to what we're seeing on junk bonds, a head and shoulder type of topping pattern, a lot cleaner than the other one here. If that gets broken down, again, that's a big signal that we're getting from transportation stocks that economic activity is deteriorating, and it's deteriorating quickly. So these patterns, this underperformance in economically sensitive stocks, in high yield bonds that are sensitive to risk, these setups, these divergences are not telling me that we should be expecting a soft landing. Quite the contrary, it's telling me financial markets are slowly beginning to actually be concerned about a hard landing. It's just that most investors have not woken up to that fact that that is the scenario we're heading in. And by the way, these were stocks that we were very bullish on. We were very constructive on transportation stocks back in September. If you go on our website, you look at our closed trades, we have a complete track record of all the trades that we've had on the model portfolio since its inception. We added IYT, the transportation ETF, as a long position on the 27th of September in 2022. That was right here before a very considerable run on this equity sector. Lots of our members were able to benefit from this trade, but now it's a completely different story. Now we have recession fears that are coming into the picture. Economic deterioration is ahead of us. These stocks are definitely not oversold like they were here in September, pricing in a lot of bad news. Momentum is clearly fading to the downside, lower highs being made. This is a much different look. So all of that information does lead us to suggest that we're not going to be breaking out here. Now, even though there might be some days where you see a lot of optimism, it seems underneath the surface that we are getting the market reactions that we should expect leading into a recession, that the only thing that's not priced accordingly is big cap technology stocks that are holding up the market right now, and we don't think that's going to last very long. Now, of course, that's our opinion based on the research that we conduct at gameoftrades.net. There's lots of different opinions out there, but that's the way we see the market. That's the way we're positioned. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.